The discussion about price action trading and whether it's better than trading with indicators is as old as trading itself. There is often a huge argument underway between the traders who think price action trading is the best way of trading the markets and the traders who think using technical indicators is the best way to trade. Price action traders always say price action is better because it doesn't lag behind the market action, whereas the indicator traders state that trading with indicators is simpler than trading with price action because you only have to learn what the indicator is showing you in order to use it. So today I want to settle this argument once and for all by breaking down the differences and similarities between the two methods and by debunking the most common myths about these two trading approaches. The first myth is that price action is better than indicators. Price action traders claim that it's a much better trading method in general. I'm not saying this affirmation is false, but if you dig a little deeper, price action and indicators are not that different. Candlesticks or bar charts are tools to visualize price information on your charts. Indicators take the same price information and apply a formula to it. Indicators don't add or take away anything from the price information you see in your candlesticks. They just process the information in a different way, and I'll explain this later in the video. The second argument is that indicators are lagging, while price action is leading. A trader who claims that indicators are lagging hasn't understood their true meaning. An indicator takes past price action and then visualizes the result after applying a formula to it. Thus, what your indicator shows you is a result of past price action. However, a trader who analyzes pure price patterns does the same thing. If you are looking at a head and shoulders or a triangle pattern, for example, you are also looking at past price action, and price has already moved away from your potential entry point. You see, both methods use past price information and are thus lagging, if you want to call it that way. To overcome the lagging component, you would have to set your indicator to a shorter time setting, or only use a few past candlesticks to make your analysis. However, the analysis becomes less and less significant the fewer information you include. Another argument is that price action is simpler and better for beginners. In trading, it's rarely true that one thing is better than the other, and it usually comes down to how you use your trading tools. Both trading approaches work very well if you understand when and how to use them, but neither will help you if you don't know what to do with them. Without experience or proper guidance, it's very easy to feel lost as a beginner price action trader. Trading candlesticks is not as easy as it sounds, and lots of components often get overlooked, such as the size of the candlesticks, how they compare to previous price action, and the component of momentum and volatility in wicks and bodies. Don't make the mistake of choosing price action because it looks simple. A trader who doesn't understand the nuances of price action trading can easily read charts in the wrong way. The same is true when trading with indicators. Another argument is that price action trading is better because indicator charts are messy. This is partially true. Of course, if you apply 6 or 7 oscillators and 10 moving averages to a chart, you can quickly clutter up your screen. But that's not how indicator trading works. When it comes to indicator trading, professional traders usually pick one oscillator to analyze market momentum and another indicator to determine the trend. A good combination, for example, is the stochastic, which is a momentum-based oscillator, and the moving average. Indicators can provide guidance and help traders make objective trading decisions. There is very little room for subjectivity when it comes down to analyzing an indicator. On the other hand, price action traders who look at blank charts can easily feel lost, lacking the clear reference points or tools to help them make trading decisions, resulting in acting emotionally or impulsively. It's also possible for price action traders to create too much noise on their charts by using too many support or resistance lines, trend lines, or candlestick components. So, while some traders feel more comfortable using indicators to take away some of the subjectivity, others prefer price action analysis. Another myth is that professionals don't use indicators. Again, it's very hard to validate such a claim, and it all comes down to personal preferences. A professional trader chooses his trading tools wisely and understands the pros and cons of the different approaches. There is no better or worse when it comes to price action versus indicator trading. It all comes down to how a trader utilizes his trading tools to make trading decisions. Now that we discussed the arguments in favor and against both trading styles, let me explain how I personally approach the markets. Considering how different price action trading is compared to trading with indicators, it's amazing how many similarities they actually share with one another. Both price action traders and indicator traders will make all of their trading decisions using a price chart, and they will both determine which direction the market is likely to move using just the market price. The big difference between the two is in the way they both analyze the price to make predictions about the future. All indicators are derived from past market prices, which essentially means the indicator traders are trying to predict the future using only the past. Price action traders do this too, but with one very important difference. They are trying to predict the future by combining what happened in the past with what's happening in the present. That's why I tend to make my trading decisions based on price action in the first place. For example, a typical price action trading strategy will be one where the price action trader will determine a level in the market that's formed based on the past price history, and then watch the price to see what happens when the market returns to that old level. If the market comes back to the level and produces a price action pattern the trader has knowledge of, he could see this as being a sign the market wants to reverse and move away from that level, in which case he may enter a trade. In this example, a price action trader has used the past in conjunction with the present to formulate a bias as to where the market might be heading in the near future. He knew the market had reversed at that level in the past, but he doesn't know if it's going to reverse at it in the future. So instead of just jumping into a trade, betting the level is going to cause a reversal, he waited until the market returned to that level and analyzed if the resulting price action confirmed that the level had a high chance of causing a reversal. This is how most price action traders analyze the market. They either use the past combined with the present to make trading decisions, or they just base their trading simply by analyzing what's happening in the present. That's why I think price action trading has an advantage over trading with indicators. Now the main difference with indicator traders is they make all of their trading decisions on things which have happened in the past. They don't combine the past with the present like price action traders do, they just use the past. This is because all trading indicators are calculated from past price action, so they don't show the trader information based on what's happening right now. They show them information based on what has happened in the past. So the truth is that traders who make all of their decisions using indicators will always be late in reacting to changes in the market, no matter which indicator they use or strategy they use. For this reason, my preference is to determine what the price action is doing before consulting an indicator for an entry signal. Once I determine the trend and find the key levels in the market, then I can consult an indicator for an entry signal in the direction of the trend. I'm not a pure price action trader, and I prefer to add an indicator to confirm my bias. In this age of algo trading and expert advisors, indicators cannot be completely removed from the equation. The most common issue is that they are lagging, but this can be taken care of if you know how to combine price action with indicators. I prefer to add an indicator in my trading setup because indicators can offer clear signals. Indicators can also provide reference points on plain charts. Many traders argue that they feel lost by looking at blank charts. Decision making becomes harder with no reference points to guide you, so indicators can save you a lot of time since they focus on specific points of a chart. In the end, it's all about the preferences of each trader. Some traders prefer pure price action. Some are ignoring it completely and use indicators and are consistent with their gains, and some are using a mix of both methods. You just have to use both tools wisely and then figure out which one helps you in making better trading decisions. As always, if you learned something new and found value, leave us a like to show your support, subscribe to our channel and click the bell icon to stay in touch when we upload new videos. Until next time.